All right. Well, Amanda, if everyone's ready, give me the green light and I'll get started here. All right, sounds good. Well, thank you, and good morning to everyone from Kansas City. It's great to see some of our clients in the room as well as the other NOSA attendees. As Amanda mentioned, I'm her co-founder or the co-founder of Plex Capital and currently serves the Chief Operating Officer. So I appreciate everyone attending. Credit and underwriting typically aren't the most exciting topics in the world, but as most of you know, that it is critical to understand in order to best operate your agencies on a go forward basis. So I'm hoping some of this can be interactive. I'll start talking through. And then at the end, if there's questions in the interim, feel free to raise your hand. Amanda will field those. And then towards the end, we can do some Q&A as well. But for that, I will go ahead and get started here. So just a little bit about the current state of the industry and speaking specifically about healthcare facilities here. So most recent data from the American Healthcare Association shows 98% of nursing homes face some type of staffing shortages. 48% of that they qualify as severe. 96% of assisted living communities say they're currently short-staffed. 99% of the above saying that they're requiring their current staff to work overtime. The healthcare staffing market should be over $47 billion over the next 5 years. And there's currently 3,000 nursing homes that have changed ownership over the last 5 years. And we'll get into a little bit about why that should matter. The most recent data from the CMS show there's 15,178 licensed providers in the United States and 28,000 assisted living residences. I include that in there because that's kind of your market for those in the room that are staffing those types of providers. It does not include hospitals or some other types of businesses you may staff, but your current I guess your world to solicit is over 15,000 nursing homes and over 28,000 assisted living residences. So it's an aging population. Those numbers will continue to climb, particularly in the assisted living residences. Most cities that I'm aware of are like Kansas City. It seems like every corner there's a new senior living facility that's being built. And so, yeah, it should just continue to create more and more opportunities for staffing agencies. So those are some of the pros. You look at the other side, with every pro, there could be a con. So right now, nursing homes, by and large, are losing money on a month-to-month basis. They're showing about $34 billion in revenue losses this year. One of the major providers, ProMedica, just announced, and it was earlier this week, $105 million operating loss in the quarter. So they're projected to lose nearly $500 million this year on their skilled nursing portfolio. The American Healthcare Association predicted 1,800 closures of skilled nursing homes due to COVID. Occupancies, at least in some areas, are way down. There's a 52% average turnover rate at skilled nursing facilities. If you look at the ones that are 1-star or poorly managed, those numbers can be much, much higher, in some cases over 100% turnover rate. And then there's also the complex ownership structures. Gone are the days to where you may just have each nursing home was either owned by an individual, maybe they owned a couple. Now it is far more complex than that in a lot of instances, to where you may have one entity that owns the nursing home, another entity that owns the building, another entity that actually manages the nursing home, and then another entity that may be actually paying the bills. And so as a staffing agency, as you'll see later in this presentation, it becomes more and more critical to know who are you actually dealing with here. And then there's been several rural nursing homes that are kind of been hit the hardest, that are being closed down a lot of times by the state, simply because they're just not, they don't have the capital to remain operational. So if we talk a little bit about just business credit in general, some of you that I did this presentation about a year ago in the actual NOSA group, and I've updated some of the data in here, but kind of the highest level I can tell is when you look at business credit, when you're analyzing a customer, if this is someone you want to extend credit terms or not, you really need to kind of remove what you know about individual credit. As it relates to a business or a nursing home, there is no credit score that's uniformly used in the business world. There are various credit agencies that may have their own scoring system that they use, but you can't look at a business and say that business has a 700 credit score, an 800 credit score, or a 500 credit score, and have that be an indicator of if they're someone that is good at paying their bills on time or not. There's just no magical score out there. There's a lot of third-party credit services, and they're operate very similar to the individual, the TransUnion's Experience and Equifax. They go out to other businesses, Plex Capital being one, and ask us to provide them data on how businesses pay us, what our current outstanding balances are, how long it's taken businesses to pay us. They aggregate that data, much like an individual credit bureau, and then turn around and sell it back to us. So a lot of cases, these credit agencies are selling us our own data back, but they combine it with all the other financial institutions as well. So unlike consumer credit reports, these business reports are far more expensive. For those of you in the room that have ever reached out to like a Dun & Bradstreet and asked them, hey, what would it cost to have unlimited access to business credit reports? Probably shocked at the price that they would charge as you compare it to maybe getting your own free credit report once a year. As a staffing agency, just understand whenever you're providing staff to a nursing home and you're providing them terms, whether it's net 15, net 30, net 60-day terms, that is an indirect way of extending unsecured credit to that facility. And so while in your eyes, you're saying I'm providing staff or workers, or these are my employees that are going there, from the facility standpoint, you are a vendor. The staffing agency is a vendor. And so you're going to go right in line with all the other vendors that they have to pay, whether that's their suppliers, their utilities, their rent, etc. So you have no set collateral when you're providing staff there. So when you're granting credit, it is truly on the promise that you hope that facility just has the ability to pay you. There's nothing for you to go to pick up and take if they don't. And then it's also important to understand what is the entity that you're actually contracting with. when you sign your staffing agreement, and we'll talk a little bit about some things to do with your staffing agreement later on in this presentation, but look at who's the entity that's actually signing that contract. Who are you contracting with? Is it the actual nursing home? Is it the name of a management company that they're using? Is there a third party involved, like a VMS that's out there? Who is actually signing the contract, stating that they are agreeing to the terms that you're providing in your staffing agreement? Some of the larger ones will ask you to sign their contract. They have a set vendor or staffing agreement, the more established ones. And there's nothing, on the surface that's wrong with that, but you do want to go and look and understand. In particular, with a lot of these VMS providers that are out there, just understand when you staff there, many times you're staffing on a pay when or pay if paid basis. And what that means is that VMS typically isn't going to pay you until they collect payment from the actual facility. So in an instance like that, we'll use career staff as a good example. Career staff, you're relying on their ability to analyze their customers' ability to pay them on time. And so it's really an extra level of analysis that you have to do, because if career staff, maybe they didn't do a good job analyzing the credit of their customer, you are the one as the agency that's going to suffer from that, because they most of the time are not going to pay you until they collect. And that's not limited to career staff. That's how most of these VMS relationships are set up. It's called a pay when paid term in the contract. So just sum that up, personal credit is very much a science. There are all types of data and websites say, do this and your credit score will go up, do that and you won't have a hit on your score and all that. Business credit is by far more an art form. We are going out as, I'll use Plex Capital as an example, when we're doing an analysis on a hospital or a skilled nursing facility or assisted living, we're going out and looking at several different data resources in addition to our own payment history and also industry terms before we establish any type of credit limit. But there is no set, hey, I look at this company and I know there's little to no risk that they don't pay their bills. There's always that chance because it is a highly evolving industry right now, based on some of the cons that we talked about in the earlier slide. So let's talk about what actually matters when we're looking at the business credit. Clearly, number one is payment history. Plex Capital, because we kind of specialize in the healthcare staffing, we have a lot of history with a lot of the nursing homes, hospitals, assisted living communities. We're very familiar with a lot of the management companies that are involved. We've established contacts and relationships with a lot of these companies. And so we can go back and look at our own history with that particular facility and use that as kind of a guiding point. Again, there is no magic score that's out there with business credit. So we may look to see there's data that they've paid their mortgage on time, but they have data showing that they have never paid us on time on behalf of staffing agencies. Well, we are going to put more importance on their timeliness and paying staffing invoices than we would that they paid their mortgage or their rent on time. How long have they been in business? And what you want to do is separate the entity from the building. It's not the same thing. And so you can look at, you go to the CMS data and you can say, okay, well, this facility has been participating in CMS since the 1970s. Well, it doesn't really mean that the business that currently owns it has been around for that period of time. It's really different. So if you're contracting with XYZ, nursing home in Kansas City, what we will do is go out to the state, see how long has that actual entity been in business, and use that as a guiding point. The problem you can run into in business credit is, let's say the previous owner of that facility had a fantastic track record of paying bills on time, but now there's a new owner, but the name hasn't changed. Same name, different owner. Well, if you're just looking at the business credit of the name of that nursing home, you're probably going to get some bad data because you're getting the data from the previous owner and not the current one. So you got to dig a little bit deeper when you're looking at that because it's not the same thing. Do they have a management company? Is the management company reputable? Are they brand new that just stepped in? So you want to do some research on that. And there are some data sources out there where you can go and pull up a management company and see how many other facilities that they are currently managing. What's the occupancy rate? A lot of times you can look at a skilled nursing facility from a very similar to how you can a hotel. A hotel needs a certain occupancy rate to be profitable. A nursing home is no different. If you pull up data from CMS, you see this nursing home has 300 beds and they're only 20% occupied. There is zero chance that nursing home is operating at a profit. Doesn't mean necessarily they won't pay a staffing agency bill. As you saw earlier, ProMedica is losing $35–40 million a month, but they're paying their bills. Slow, but they're paying. So you want to look at the occupancy rate. Is it trending up? Is it trending down? And then we also give a little bit of value into the CMS rating. Generally speaking, businesses that are poorly run usually are poorly at paying people on time as well, either because they don't have the revenue coming in because their occupancies are low, or they're so poorly run that their administrative staff, so the administrator, the BOM, et cetera, those turn over at a high rate as well. And so what happens is you have an administrator, they've signed off on the invoices, they quit on a Friday, new admin or the BOM comes in on Monday, takes everything on the desk, throws their way to start over, and all your invoices went in the trash as well. So it kind of restarts the process. So all of these things, there's not a single one that sticks out that says this is the only important thing, and if they do this, everything else is fine. It's really a high level. You have to look at all of these data points as a whole to be able to determine if this is someone that is worth working with or not. So those are the things that matters. Yeah, here are the things that I say that really don't matter as it relates to analyzing the credit. The length and time that a facility has been there. You never want to say, oh, they've been there forever, so they pay on time. The most recent example, there's I think a 900-bed facility in San Francisco called Laguna Honda. If you've seen any of the news that's come out, federal government ordered them to be shut down. They've been around, at least since the 70s. It's actually owned by, I believe, the city or the county of San Francisco. But they've been ordered to be shut down. There's litigation going on right now. Think of Sears, Enron. These are all companies that have been around forever. But on a long enough timeline, every company at some point fails. So you never just want to look at how long it's been there, because also, as we mentioned earlier, just because that building's been there doesn't mean the person that owns it or managing it right now has the same amount of years of experience. They may have bought it yesterday. Unless you dig into it, you don't know that. There's always the administrator. I know him. We've been friends. Maybe you used to work for the administrator when you were doing bedside care. They assure me that they will pay. You can have a great relationship with an administrator, but at the end of the day, that administrator is not the one that's paying their bills. They don't have the power of the checkbook there. Their job is to administer the nursing home, which in a lot of cases is calling on you all to get staff in there so they can get their patients or the residents taken care of. So they are the advocate for the nursing home. So in some cases, not always, but in some cases, they will tell you whatever you want to hear to get your staff in there. Next bullet, they're begging me to provide staff. They're desperate. Sometimes you got to take a step back and look at that and say, okay, well, why are they begging me? Okay, who is the last staffing agency that was just in there? Why are they not there anymore? Um, you know, be cautious a little bit if you get a call out of the blue and say, hey, I need staff here tomorrow. Well, what happened? Did your current staff all quit on you this morning for one reason or another? Did the incumbent staffing agency just pack up and leave because they've got $100,000 of unpaid invoices? Um, it may be a great opportunity, but you want to dig a little bit deeper before you start sending your people in there. I like this one. It's a very nice or brand new facility. Looks can be deceiving, even as it relates to nursing homes. I've got a lot of history with beautiful buildings that can't seem to pay on time. So just because they have a nice facility, maybe they're spending all their money on capital improvements and have no money left over to actually pay their operating costs. Or something that says they are owned by a bigger company. There are a lot of examples of facilities that have large conglomerates that own them. But as we talked about earlier, understand who it is you're contracting with. And the legal structures of these nursing homes are far more that specific home has a separate LLC that owns it. And maybe that LLC is owned by this mega company that has, millions or billions of dollars. Well, you only get to go after the company you're contracting with. And so that big company, it's very easy for them, if push comes to shove or the state's coming in to shut them down, they can just bankrupt that company and you don't have rights to go after the big company with all the money. So just because they're owned by a bigger company doesn't necessarily mean that you should have no concerns about staffing there. All right, so let's talk about your staffing contracts. This is the number one way, in my opinion, that you can ensure that you get paid on time. And it is also the number one way you can ensure a massive amount of headaches if something goes wrong. So I'll give you my disclaimer. I'm not an attorney. Cannot give you legal advice, but I can tell you these are some of the things that I've seen in staffing agreements. And, your staffing agreement is there to protect you in case something goes wrong. And if you are in this industry long enough, sooner or later, something will go wrong, in which case you're going to look to the staffing contract that you signed, and you're going to hope that you had that set up correctly to protect you so you know how to go and try to collect on money. So that agreement's going to determine how. Yes. No, you're fine. Give me a chance to sip on my coffee here. So, um, as Amanda mentioned, it's okay to start with kind of a boilerplate template. Maybe if you know someone that says, "Hey, here's a staffing contract that I use," as a starting point. But before you start sending that out to prospective customers, you need to get a business attorney in your state or whatever state that you're going to be staffing in to look at that and make the modifications. Every state has their own laws. Different states have different laws as it relates to what kind of late fees that you can charge or what notice periods are. So if I'm in Kansas, I wouldn't want to use a staffing contract that was prepared for businesses in the state of Texas, because my state laws may be different. So you can start with kind of that boilerplate contract, but please, please, please go to a business attorney, preferably one that understands contract law in your state, and have them review and maybe even give them some highlights of points on here. I've seen several contracts from Plex clients and also just other businesses where they may be operating in the state of Ohio, but the contract that they used was sent to them by a friend in, I don't know, Arizona. And in that contract, it says any litigation must be brought in the state of Arizona, which is, you've got an agency based in Ohio, a facility based in Ohio, but that contract says if you're going to sue, you have to sue in Arizona, because they never took the time to actually review it and change some of the jurisdiction and whatnot. So just understand your contract, get it reviewed by an attorney. You will, the $500,000 or whatever that you pay to that attorney, you will earn back 1,000 times over the first time you actually need to use this contract. So in my opinion, if you're a newer staffing agency or an existing one, that's the best investment. And have your attorney, if you had them prepare it, have your attorney take a look at it every so often. State laws change. Or maybe there's something you want to get added on there. So some of the common provisions that we've seen in what I would consider quality staffing contracts, a timeline to approve invoices. What you want to do, obviously, you're sending your invoices to that facility on a weekly basis, and you want to make sure that you have some level of timeline where they can approve that. Most of these bullet points I put on here are because we've experienced, I would say, horror stories with contracts that didn't have these types of things. So to give you an example, you're staffing at X dollars an hour and you're sending invoices to the facility, but there's no timeline with which they have to approve invoices. And then 30 days later, after you've staffed 4 or 5 weeks, they say, oh, you know what? We meant for the invoice to be at this rate per hour and not that rate per hour. Well, you didn't ever give them a timeline to approve the invoice. So now suddenly, instead of having one invoice that's in dispute, you've got 4 or 5 that are in dispute. Assignment, what happens? These nursing homes are changing ownership all the time. What happens when the ownership changes, the management changes? I will say if the entity that you signed the contract with is no longer the owner or the manager in some cases of that facility, your rights under the contract stop. You need to get a new contract signed with the new owner. And then we would want to reevaluate the credit on the new owner before you agree to continue to provide staff. You also want to have a very clear understanding of, hey, is that old owner, who's responsible for any outstanding invoices? Is the new owner, are they stepping in and are they covering that? Is the old owner still required? We've seen a lot of circumstances where the old owner sells the nursing home and then they just disappear, and they say, well, I don't have the money to pay the old invoices, and the new owner's not responsible. So you kind of find yourself stuck in the middle there. So what happens? Payment terms, including the payment of undisputed balances. 30 days is typically what we see. That's the reimbursement schedule that most of these nursing homes are going to get when they're getting their state or federal money on a 30-day basis. So just understand that the longer your payment terms, the greater your risk is. If you give a facility net 7-day terms, your risk is 1 invoice if you're invoicing on a weekly basis. So that's 1 week's worth of payroll is what your credit risk is if you're on net 7-day terms. If you're on net 14, it's 2 weeks. Net 30, it's 4 to 5 weeks. If you're giving net 60-day terms, that's 8 to 9 weeks worth of payroll is the actual risk that you're putting out there. Usually, if you're granting terms in excess of 30 days, your customer really is just treating you as their bank. You're financing their business when you do that. Not to say that it's always it's not a good move to do that sometimes. Sometimes it makes sense. They're good payers. They just pay in 60 days. Your margins are fine. Um, but just understand the longer those payment terms, the greater your risk is. Um, Something that's a little bit timely on here: push to get payments electronically instead of getting checks mailed out to you. Or if they're going to mail checks, depending on the size of the invoice, require them to send it some type of priority mail. We've seen time and time again, as understaffed as nursing homes are, the United States Postal Service is understaffed as well. There are delays. They're shrinking their staff. The first class mail is being slowed down. So what I can tell you in all my years of doing this, I've never had a wire or an ACH get lost in the mail. The beauty of those types of payments is when they send a wire, it shows up. When they send a direct deposit, it shows up. There is no, I don't know where it is. It's very easy. One of the tricks that facilities will use sometimes, they'll say, "Oh, the check was dated, August the 10th or whatever. That's when we signed the check." And then 2 or 3 weeks later, we actually get it in the mail. We look at the envelope, and it was mailed, a week and a half after they actually printed and signed the check is when it was postmarked. And that's just another way for them to delay payments. So it is always in your best interest to push for electronic payments if they can. If they have to mail it, push for, and it's a larger invoice. It amazes me companies that won't spend more than, I don't even know what a first class stamp is right now. Let's say it's 50 cents. They're mailing a $60,000 check, and they won't spend the $7 to make it a priority mail. They want to spend 50 cents on a stamp. Some of these business expenses are just worth your time to get that check to arrive and at least have some type of tracking on it, or cover the cost of a $15 wire that comes in. Yeah. Sure. And I think just in business in general, and as it relates to your staffing contract, if you don't ask, the answer is no. So there's no harm in asking for everything. It's just a negotiation. It's no different than, trying to figure out what your bill rate is. It's a negotiation. Same thing with electronic payments. And these little items you can put in that staffing contract it can save you a lot of heartburn and hassle down the road. Make sure your contract has specific language as it relates to late fees, collection fees, attorney fees, etc. These are all the things. Okay, what rights do you have if that invoice is not paid within terms? I've seen a lot of them. This is where you'll want the attorney in your state to review it, because a lot of states have specific laws surrounding what you're able to charge in contract law. The last thing you want to do is you've adopted a contract from another state. You go to charge late fees on an invoice, only to find that the late fees that you put in your contract are considered usurious in your state, so you're not allowed to charge any. So you want to go beyond just saying, if I don't get paid on time, the facility is responsible for my attorney fees. Have your attorney in your state put the proper language specific for your state as far as what you can charge on a late fee, attorney fees, collection fees. You want to specifically have them list those items out to best protect you. And then it just becomes a business decision for you, right? If your facility pays 1 day late, are you technically allowed to charge a late fee? If your contract says so, you are. Whether you do or not is a business decision that you would make. But I will tell you, having this language in your contract, if you have to go and litigate because you're not being paid, that is a big pro for you to have that in your contract, because no one wants to pay the other side's attorney's fees. Jurisdiction is also important. You want to make sure if you're located in the state of Georgia and the facility's in Georgia, you want the contract to say if you have to sue, you're going to sue in the state of Georgia. I used the example earlier of someone that had just pulled a random contract off the internet or something, and that contract was going to say they had to sue in a state where the agency and the facility, neither one were located. So you don't want that. So make sure you understand what jurisdiction your contract says you're going to sue in. Sometimes there's even benefit if you're using some type of payroll funding company. You may even want to include where your payroll funder is located as an option for jurisdiction, because sometimes that could be more favorable than the jurisdiction that your particular agency could be in. And then the last thing, just take caution whenever you're negotiating rates via text, email. Maybe you had a staffing contract signed by, the general counsel of XYZ healthcare, and then you get a call the day before Labor Day, I guess, is coming up. So the Friday before Labor Day, the administrator calls that I got to have staff here on Monday. I'll pay you an extra, $1,000 a CNA or something like that to get people in there. You say, great. You send them, you invoice, and then they come back and say, well, I can't pay that because, the administrator said they were going to pay. I've got litigation right now going in 3 different states over this exact example, where the corporate office is coming back and saying that administrator did not have a contractual right to enter into to offer that bonus, that renegotiated rate, or whatever. So even though you've got a text or an email from an administrator or a BOM or the DON or whoever there, if that person doesn't have the authority to do that, to renegotiate those rates, that can present problems for you down the road. And yeah, you've got some defenses to go. You can say, well, they present themselves as having the authority to do so. But a lot of times, whatever that contract states is what you're going to have to go off of. And if your contract states that the only person that's allowed to renegotiate on behalf of that facility is Josh Good, general counsel for XYZ Healthcare, then you're taking a risk if Josh Good at XYZ Healthcare isn't the one that's agreed to those renegotiated rates. So take caution. We saw a lot of this as it related to the tail end of COVID rates earlier this year. People suddenly didn't want to pay the COVID rates that they had agreed to. Bonuses are in question, and we've got a lot of litigation going on out there right now for these exact things. So please make sure if you're going to change the terms of your contract, go through the proper channels, get a new contract signed, because that's what you want, and not a text message from Joe, the administrator, saying that they would pay it. Touch a little bit about the payment process, save you on some Advil here. We're all in the healthcare industry, right? So the vast majority of late payments are caused by operational issues and not financial issues. Most of the time, what we see are these facilities are not paying because they are unwilling to pay for some reason, not necessarily that they're unable to pay. So what we're talking about is the invoice hasn't been sent to the right place, or didn't get signed off on by the right person, or the administrator quit and the new one threw everything away as soon as he or she started. Those are the types of things that we see slow down, or the wrong address got put. You put your old business address on the application, and that's where they're sending the payments to. Or you have some other address listed on a W-9, and that's where checks went to. There's just a host of operational issues that are what really cause the delays, as opposed to financial issues. The financial issues you try to mitigate through a good credit analysis process, but it doesn't matter how good your credit analysis is if you're not following the preferred method of getting invoices approved. That's an operational issue, not a financial issue. So what do you do when you're starting up or signing up with a new facility? Just ask, understand the process. Hey, when I have these timesheets and I'm going to invoice you once a week, I've got your invoice, I've got my invoice, and I've got timesheets. Where do they need to go? Like what is the process? Who is signing off on them? Are you using my timesheets? Do you have your own timesheets? Is it a combination of the two and you're comparing them? Is there a VMS where I'm just looking online and seeing what's out there? What is the process of getting these timesheets approved? And make sure you understand who that contact is that's going to do it. Some VMSs, you have to log on and actually sign off on it yourself, saying you're approving what they're showing your staff worked. Make sure you understand that. And if there is something that you need to do on your end to get those approved, do that timely. The last thing you want to do is to wait 30 days to go in and like, oh, I forgot to go approve all of these shifts in whatever VMS you're using. And now suddenly, instead of being a 30-day turn, now it's a 60-day turn because they don't start their pay cycle until you've approved the invoices. Find out if additional approvals are necessary. A lot of times, maybe you have someone at the facility level that signs off on the shifts. Then it goes to a corporate office, and then someone in accounting there is actually looking at your bill rates and making sure that they match your actual contract. And so there's an additional level of approval that's necessary. Where are the payments coming from? Used to be easy, right? Whoever you contracted with, they've got a checkbook there. They're writing the payment, mailing it to you, and it's done. It's not like that anymore. Sometimes the facility sends the payments. Sometimes there's a corporate office. Some of you have staffed, Signature Healthcare or Saba. There's all kinds of these different, big conglomerates that, the actual approval on the invoice may come from the facility, but then there's some conglomerate or parent company that's sending the checks out. A lot of times there's a management company that's involved. One of the bigger ones out there, Apex Global. They're a massive management company for these skilled nursing facilities. Well, the way they operate is they will send the payment, but that nursing home has to first send them the funds for them to turn around and then send them out. So who are you following up with? Are you following up with Apex to say, hey, have you sent the check out yet? Or are you following up with the nursing home to say, hey, have you actually sent the money to Apex so they can turn around and send it to me, the agency? Is there a VMS involved? And then is there another third-party payment? So there's AvidPay. Yeah. I'll speed up the process. I thought I had an hour, so I'll speed up the process. But so just understand the payment process from your facilities. I'll talk real briefly here on how to collect on your past due invoices. The number one thing you can do is make sure you don't get past due invoices, which is to follow the process and understand the process of that specific facility. So the next thing on here, the first thing you want to do is you want to make sure you have a relationship with the people at that facility. We always say, we have this mantra, kill them with kindness. If you call and you're just screaming all the time, you know what? A lot of times the person you're yelling at isn't the person that's making the decision of whether you get paid or not. And if you just tick them off, you're probably going to be the last one whose name gets brought up when it comes time to pay vendors. Kill them with kindness, but don't ignore the problem. Sometimes you got to be a squeaky wheel to get the attention. Call them every day if you have to. The strongest leverage you have as a staffing agency is to pull your staff out of there. We've seen that used a lot of times to the agency's benefit. You say, look, if we don't get paid, my staff's not going to be there to take care of your residents on Monday because I can't afford to continue paying my staff and never receive payment. Go visit them. If you know the ownership of that facility is the one that's making the decisions, go make a site visit. You don't have to take a baseball bat with you or anything like that, but you can go in there, sit down. These are business owners. You're a business owner. Sit down and have a professional conversation with them. Find out what's going on. Beyond that, as you escalate things, the next one I would tell you to send out a demand letter. An attorney usually can do this as well for you, saying, hey, you know what? I've tried. You owe the money. If you don't do this by this, we're going to have to turn up the pressure on you. And then your last option is always to actually sue them and litigate the process. It's always the last resort. I will say typically attorneys are the only ones that win as it relates to litigation. If something actually has to go to court, most jurisdictions that we're involved with right now, it's about a year out before you can ever get in front of a judge on something, even if it's an undisputed contractual obligation they have to pay you. It takes forever. And so that's always the last case resort. What we would tell everyone to do, and what we do ourselves, is to try to exhaust every other means possible of collecting before you decide to actually go and file a lawsuit. And then just make sure you understand litigation. Some of you may benefit from looking at various types of credit insurance. Diversify your customer base. That's more than just, if you're working with 10 facilities all owned by the same company or the same management company, that's not what I would call diversity. The more diverse you can be in who you're staffing, the less risk you have. And then just monitor. Don't ignore your receivables. If someone's supposed to pay in 7 days or 14 days and they're not, get them back on track. If you don't follow up, businesses will take advantage of that and say, well, they're not going to call me if I'm late, so I'll pay them next week, or I'll pay them when I get money. So just make sure you're always keeping an eye. It's your business, right? If it doesn't matter what your margins are, if the facility doesn't pay you, your margin is zero. And it's actually negative because you've paid your people. So keep that in mind. So, all right, Amanda, I'm wrapping up. I'm done. They got to eat. Oh, yeah, it's 10:45 in Kansas City. So I forgot you guys are. I got a hungry crowd here. So. I do. That's right. Yeah, so a lot of times I'll tell you to defer to your attorney on that. But what we have seen is you want to have jurisdiction that's most advantageous for you. And so in some states that may be the state that your business is formed in, maybe the most advantageous if you ever have to sue. So that's where you want jurisdiction to be, regardless of where you're staffing. But you need to have it, considerations, especially as it relates to late fee and attorney fee provisions. Some states specifically cap what you can charge. And so, you'll want to take that in consideration. But yeah, there might be some examples where you have to have different contracts for different states because of those state specific regulations that are out there. Yeah, so yeah, so when I speak of management changes, I'm really talking about like a management company, different management company is coming in, and the old management company is leaving. Not necessarily the administrator is changing, that sort of thing. Um, Usually, when ownership changes, they have to send out some type of notice saying, "Hey, your contract with us is terminated as of August the 20th because that's when new ownership is taking over." Um, I've not always seen that to be the case. You'll want to make sure that your staffing contract will specify that you have to be provided notice if there is any change of ownership. And you would have, in my opinion, some legs to stand on if ownership changed, they continued to accept your staff. And then if the new owner said, "Oh, well, I don't have to pay you because my contract, I don't have a contract with you," I maybe that was something you would have to litigate, but I think you would have a pretty good leg to stand on. What you don't want to have happen is you've been notified of a change of ownership. You've been told that your contract is terminated as of August 20th because that's the last day of the previous ownership, and you continue to staff without a new contract signed with the new owner. That can put you in a very bad situation because you're essentially operating without a contract, and that new owner may just decide that I'm not going to pay those rates, and I don't have a contract saying I have to. So it's really, if you know an ownership has changed, before you send staff there, make sure you have a new contract signed with the new ownership and everyone is understanding what happens to any existing invoices. Whoever you sign the contract with. And so if your contract is with XYZ facility in Kansas, XYZ LLC in Kansas, that's who you get to go after. They might be owned by ABC, healthcare in Georgia, but your contract's with an LLC in Kansas, and if they don't pay, that's who you get to go after. So something to consider in that case is you can add multiple parties to a contract. So you can say, hey, this contract is between EFG Staffing Agency and I'm contracting with ABC Facility in Kansas and XYZ Healthcare in Georgia. And then they're both liable. They're both parties to that contract. So, Amanda, I'll say one last thing in closing here, and then I'll take any other questions. And everyone here is you're certainly welcome to contact me offline. You can find me in the NOSA group, or Amanda can certainly share my contact. If you have customers that you'd like for us to run credit on, I'm more than happy to do so. Just shoot me an email. Hey, this is a customer. I don't, doesn't matter if you're a client of ours or not. Happy to look into it and just let you know kind of what we would do as it relates to extending credit, and what history we have with that particular facility. All right. Thanks, everyone. Enjoy the rest of the conference.